Let's take a couple of minutes and talk about contingent liability. So this is a potential liability that might become an actual liability in the future. Let me give you some examples. And we have 3 different guidelines that apply. One is if it's probable, we can estimate the amount or not, whether it's just reasonably possible, or whether the contingency is remote. So this is a really good graph that explains those. Let's say that we own a business and a customer comes into our business, they fall down, they get hurt. They're going to sue us for $5 million. Okay, so obviously we'll get an attorney involved, and the attorney will tell us, for example, wow, I think it's likely that you're going to lose. It was your fault that the customer got hurt. And I think probably that we can estimate that the judge will rule in their favor for the $5 million. So it's a probable contingency and it's estimatable. If that's the case, we need to go ahead and record that liability. If it's probable, meaning the attorney says that it's likely you're going to lose, but we can't estimate an amount, I'm not sure how the judge will rule, then we just have to make a disclosure in our notes. So in the subsequent pages to our financial statements, we would put something in there that we have this pending lawsuit. It looks like we're going to lose, and the amount could run from $2 to $5 million, something like that. Now, if that liability is just possible, so the attorney says, wow, I'm not really sure how the judge may rule in this case. It's possible, I'm just not sure. Then we would, again, make that disclosure in the notes. And if the contingency is remote, meaning the attorney says it's not your fault, I can't imagine any way that the judge would rule against you, then we just kind of ignore it like it's not going on. So one of those types of contingent liabilities that a lot of companies have is for a product warranty. So if they are going to offer a warranty on their product, when we make the sale, we need to go ahead and estimate the amount that that liability is going to cost us in the same time frame when we actually make the sale. So we will create an estimated warranty liability that sits as a current liability on our balance sheet. Let me give you an example. This says here, in 2002, Denson Manufacturing Company sells 10,000 washers and dryers at an average price of $600 each. The selling price includes a 1-year warranty on parts. It's expected that 500 units or 5% will be defective, and that the warranty repair costs will average $80 per unit. So companies can do this based on past history. So you just take the number of units sold times the estimated rate of defective units, 5%. Tells us 500 of those will become defective on average, with an $80 warranty repair cost. So that's a total estimated warranty liability of $40,000. So in the same period when we make the sale, when we sell them, we're going to record the warranty expense associated with selling that merchandise. Debit warranty expense for $40,000, credit the estimated warranty payable for $40,000. So we've just created a liability here now. So once those repair start coming in, then we can go ahead and debit that estimated warranty payable and credit cash or the repair parts, whatever that might be. So in this case, looks like 300 of the units actually came in during 2002. So that was 300 times the $80 average repair cost. Debit estimated warranty payable, credit repair parts. And here, let's look at another example. This says the accounting records of Stevens Auto Repair showed a balance of $6,000 in estimated warranty payable at December 31st, 2011. In the past, Stevens' warranty expense has been 9% of sales. During 2012, Stevens made sales of $311,000 on account and paid $13,000 to satisfy warranty claims. Well, let's see how all that actually pans out. First thing we need to do is go ahead and record the sale when they actually made those particular sales. So this is going to be during 2012. We would debit our accounts receivable or cash if they paid us in cash. And we will credit our sales for $311,000. Okay, so then it says to record the warranty expense. So in the same time period when we make the sale, we want to go ahead and determine how much is going to become uncollectible. So it says their sales were $311,000, and there had been 9% is their warranty expense. So take the $311,000 times 9%. That gives us $27,990. So we'll debit warranty expense for the $27,990, and we will credit estimated warranty payable for the same amount. Okay, so we've now just added $27,990 to our liability. Let me just point something out here as well. It looks like that they had a balance of $6,000 in their estimated warranty payable. So if we drew a T account of that estimated warranty payable, they would have had $6,000 in there, and we just added another $27,990 for them to have to pay their claims with. And then we can do the actual entry here to record when those claims, $13,000, were paid. So same thing, 2012. Now we debit the liability estimated warranty payable for $13,000, and we credit our cash or repair parts, or however this happened to be paid. It says paid $13,000. So then our estimated warranty payable would be debited for $13,000. So you can see how that account actually gets created. When we pay those claims, we debit the liability.